Welcome back to the Money and Wealth Show. I'm Sterling Fox. Our special guest this week is Jillian MacPherson, Portfolio Manager with TD Waterhouse in Vancouver. And Jillian is here, among other things, to talk about the 10th Annual Female Investor Survey just released by your bank, TD, in the past couple of weeks. This is really fresh information. I talked to a few women about this, just sort of sounding out other females around me about the sort of advice that they had received from their moms when they were growing up, because your survey says there wasn't a lot of information sharing about financial matters in the young lives of most of today's Canadian women. And one woman said, well, I recall being told I should marry a guy with money. And that was about the sum total of my mom's advice. And I'm sure you've heard that before.
Well, actually, as a matter of fact, my mother said to me that if I married for money, I'd pay for every penny.
Ah, okay. All right, so there you go.
Exactly.
Two sides to that coin, too. Let's talk about risk, because
Yes.
you talk about women investors as being much more conservative and therefore risk averse than male investors. Everybody's trying to mitigate risk these days. These are real roller coaster times, Jillian. It's up and down. There's quantitative easing. There's gold through the ceiling. It's just a remarkable time in the economy. And everybody wants to mitigate their risk as much as they can. And one method that's available to investors is something called a closed call. What's that?
Well, a covered call strategy.
A covered call. Okay, my mistake.
No,
Okay.
that's quite. I specialize in writing covered calls for my clients.
All right.
Clients come to me. They are average investor who perhaps doesn't want a lot of income. They want capital gains.
Okay.
Okay. So this is an ideal strategy for someone who has a conservative basket of portfolio of stocks, and they're just looking to enhance their rate of return on their portfolio. So let's say, for example, you own Bank of Nova Scotia already, and you're interested in enhancing your yield slightly.
Okay.
I would say to you, okay, we could do this one of two ways. We could, if we just pretended we bought Bank of Nova Scotia today, we could enter into a contract and sell Bank of Nova Scotia at some point in the future for a profit.
Okay.
And the client says, well, that sounds great. What's the catch? I say, well, this is called the derivative market. This is a very straightforward strategy. So we buy you 100 shares of Bank of Nova Scotia at $10.
All right.
The person buying the contract from you, that's the right to buy Bank of Nova Scotia at $11, let's say in December this year, pays you $1. So you paid $10 for Bank of Nova Scotia. Two things happen come that third Friday in December, because all equity options expire the third Friday in which they're struck.
All right.
Okay, so if Bank of Nova Scotia is over $11, you will have deemed to have sold it. Doesn't matter if it's at 11, 12, 13.
Because that was your predetermined number.
That's correct.
Okay.
Okay, so you paid $10 for it. You received 11 off when it was called, but then you also received $1 in premium. So in which case you've made 20% profit on your Bank of Nova Scotia. And if you caught it between the dividends, when it went ex-dividend, you would actually pick up one of the dividends on the quarter as well.
Oh, okay.
Okay?
So what happens though? Now, it's not likely that the Bank of Nova Scotia or your bank, TD,
Sure.
are going to lose stock value, but you've got to look at the other side of the
Of
coin.
course.
What happens if I buy my $10 shares of Scotiabank and on the sell date, they're not worth $11 or more, they're worth $9 or $8 or less?
Sure.
What happens then?
Well, the interesting thing about that premium that you received, that $1 you received, Revenue Canada does not perceive that as income. That was actually a capital gain. So the two trades are actually technically separate, but I like to think of them together. So you could say that you've hedged or lowered your adjusted cost base on Bank of Nova Scotia by $1, let's say 9. So theoretically, you actually don't lose money until Bank of Nova Scotia declines below $9.
Oh, okay.
Now, these types of rates of return, this was just for our purposes today.
Sure, exactly. Yeah.
But I would say, on average, a stock that's fairly conservative, stuck in a trading range, I could generally pick up about 9 to 10% in returns off just writing those covered calls, having them expire, meaning the stock is just traded sideways on top, and then you would have your dividend yield on top.
Is this a good strategy for people who otherwise may become a little too emotionally attached to their holdings? We do that. This is our hard-earned after-tax money, by gosh, and we take it all terribly seriously and tend to want to hang on to stocks even after they've gone south on us, because that's my money and it's all terribly emotional. Would this help deal with that reality?
I think, yes, investors do fall in love with their
Oh,
investments.
sure, absolutely.
And, but it does employ, and it puts a certain amount of discipline. When you buy a stock and you're writing a covered call, you've actually already predetermined, okay, I've bought it at this and I know I'm going to sell it for this. And I'm quite pleased to pick up my, even if it's 8%. But if you annualize 8% over, let's just say 4 months, that's a tremendous rate of return. Then you can go on and do something else.
You know, talking about moms and daughters as we have been on this program, in terms of financial sharing of financial advice in one's youth. I didn't get a lot of exchange of that sort of information from my dad either. This goes both ways in Canada, I think. But one thing my dad did actually teach me was there's no such thing as a profit too small to take. And I think in these times particularly, that advice serves people well, not just me. Do you agree?
Absolutely. I mean, I think you have to take a look at rates of return and obviously over time. And I think people have had to lower their expectations about what is a reasonable rate of return. I mean, years ago, when it was 2000, tech stocks were running. Oh, I could get 40% on this mutual fund and everything's going to be fine.
Those were the days.
And now clients, you know what, I would just really like 4%. Do you think we could get that?
Yeah.
And now they're delighted to get that.
So in these times, here we are in the fourth quarter of 2010. It's been, to say the very least, an interesting year, especially for those of us here in British Columbia hosting the world as we did a few short months ago. How do you see 2010 ending? On a positive note, Jillian, or is there still 3 months left in which a lot of weird stuff can happen?
That's a great question. I mean, really right now, if we look at what's happened this year, we currently right now, 80% of the stocks on the TSX are trading over their 50-day moving average.
Which means?
Which would normally mean that they're trading in their uppermost part of their range.
Okay.
Logic would dictate we're probably due for a pullback here. But we've never also had, this is unprecedented with the quantitative easing as we've talked about it in the United States, and that has fueled a big fire here. And bonds are expensive, so the equity market has run. And here we are in Canada where we benefit and have a lot of commodities, and commodity stocks will run. So at this point, it's tough to say, but right now, the market seems to want to go higher.
So are you feeling, as you approach the end of the calendar year, optimistic about things ending up, at least on December 31st, a heck of a lot better than they were on January 1st?
I think things have improved, and I think over time, things will work their way out. But I think this is something that's going to take a fair bit of time to work through.
Interesting stuff. Jillian, it's been a real pleasure having you on the program today. I wish we had more time, and we'll have to get you back. And this whole Venus and Mars business, men's and women's habits and priorities, we're just different, and that's all there is to it.
Sure.
And I appreciate your patience in helping to dissect this female investor survey from the folks at TD Waterhouse. It's been a real pleasure meeting you, and thank you so much for coming by.
Thank you.
We'll be right back.
Hi, I'm Larry Ray, Chairman and CEO of Molycorp Gold Corp. Our major project in Nevada is magnesium. We have a 43101 resource of 52 billion pounds at $1.30 a pound. Do the math. Go to our website at molycorp.com or phone me direct at 604-531-9639.
Tax Tips with David Ingram.
You're a Canadian resident. You got a little cabin across the border, someplace like Point Roberts, Washington. You rent it out once in a while. You let friends and so on use it. If you are renting that cabin out, even if you're not making a profit, you have to do a U.S. tax return. Penalty can be $1,000 to $10,000, and the other penalty can be 30% of the gross rent that you received all the time that you did it. You have to file that tax return. That's a tax tip.
And that's our program for this week. Our thanks to David Ingram and to our special guest, Jillian MacPherson. And thank you for joining us. If you have some thoughts about today's show that you'd like us to hear about, send us an email to comments@themoneyandwealthshow.com. I'm Sterling Fox. See you next time.